Hello and welcome to Business Basics. So if you're an active investor, you've probably noticed that when you place orders, you have several types of orders that you can choose from. So in this video, we're going to go over 4 of those types: a market order, a limit order, a stop order, and a stop limit order. Okay, so a market order is also known as a regular order. Let's use an example. Let's take Apple. So Apple stock today was trading at around 282-ish, so in the upper 280s. Let's say that I wanted to purchase Apple stock with the market order. So then I would put in a market order and I would end up purchasing Apple stock at whatever it's selling at for that moment. So let's say it's 282 since that was the close for today. Now, in a day though, the stock's price will fluctuate. It might go up as high as 284, 285, or it could go as low as 276 or 277. So if you're an investor, you're going to want to buy low and sell high. And this especially is important whenever you're dealing with a large number of shares, talking in terms of thousands. In order to buy low and sell high, a market order isn't the most optimal order because you're just buying for whatever the market price is at that moment. If you're buying shares, then you're going to want to buy at a lower price. You're going to want to buy whenever Apple's stock for the day is trading in the 276, 277 range. And similarly, if you're wanting to sell, then you're going to want to sell those shares whenever it's trading at around 284. So market order isn't ideal for that type of investor. So what's the solution to that? Well, the solution to that is a limit order. And a limit order allows you to place an order, and whenever you place an order, you're required to set a limit. And limit orders work for both buying and selling. So for example, if I wanted to buy Apple stock, I wanted to buy it in that 276, 277 range. So what I could do is I could put in a buy order for Apple and then set my limit at 278. And what that is saying is that if Apple stock trades at or below 278, then execute my order. So if Apple stock suddenly jumps to 277.94, then that limit order ends up meeting the criteria of being less than 278 and then it's executed. And it works in the same manner for selling a stock. You set a limit, and if the price of the stock is at or above that limit, then the order ends up going through. But the downside with the limit order is if it never hits that limit, let's say you're wanting to buy a really good stock and it's currently trading at $33.50. And in order to get the most amount of return and you buying low, you decide to hold out until it hits 33.25 cents. But let's say that it hits a rally, and let's say it never ends up returning back to 33-ish. That means it's never going to hit your limit. So the danger with the limit order is that it can either A, take a long time to be executed, or B, it can never be executed at all. So our next type of order is a stop order. Stop orders work kind of similar to limit orders, except a bit in the opposite manner. So if you were required to, in a few words, describe the purpose of a limit order, I would describe it as to maximize gains. Well, a stop order's purpose is the very opposite of that. A stop order's purpose is to minimize losses. And by the way, a stop order is also commonly referred to as a stop loss order. Let's say you buy the shares of a company that's currently trading at $100. And this is a pretty volatile company. It could go up and provide super great returns, but it could just as well go down and it could fall 50%. Rather than it falling 50%, what you can do is you can set a stop price. And this stop price represents the maximum amount that you're willing to lose. Let's say with this investment, you're willing to risk 5%. What you would do, 5% of 100 is 95. You would set your stop price to be 95. And that stock price ends up crossing 95. So if it hits 95 and goes below, then my stop loss order ends up getting executed. In that way, a stop order is designed to limit your losses. And just like a limit order, it's not guaranteed to execute, and it's preferred not to execute, but obviously there is that chance that it may not execute. So there's actually an interesting caveat with stop loss orders that makes them not work as well as you might think they would. Let's say with a fictional company that you bought it at $100 and you set your stop loss to be $95. The downside with the stop loss order is that it's only valid for market hours. The stock market is open from 9:30 a.m. to 4 p.m. Those are market hours and Eastern time. From 4 p.m. to 8 p.m. and from 7 a.m. to 9:30 a.m. there's what is known as extended hours, so pre-market and post-market trading. And the stock's price can move up and down during these hours. However, a stock's movement during these hours does not count towards the stop loss order. So let's say that my stock that I purchased at $100 at 8:30 a.m. in the morning, it fell from $100 to $93. And then at 9:30 a.m., the market opened and my stock was worth $93. So you might think that the stop loss order would execute, but it turns out that it actually will not. And that is because it did not cross 95 during market hours. So in order to curb this, what you can do is you can set a stop limit order. And a stop limit order has two different prices, a stop price and a limit price. And both of these act as bounds or boundaries for your trade to occur in. So let's say that you set a range of 90 to 97. Your stop price would be $90, your limit price would be 97. So what you're saying is, okay, if it opens at this price within the range of 90 to 97, then okay, we'll sell it. And that's the way a stop limit order works. It sets a range in order to deal with the possible downside that might occur with the stop loss order. So let's recap. The first type of order that we talked about today was a market order, which plain and simple, it just buys or sells the stock at whatever price it's currently selling at. Now the downside with that is you as the investor don't have a lot of control over you buying that stock. You don't know at what price exactly it's going to be purchased at. It's constantly fluctuating many times in seconds. So the alternative to this is a limit order, where you set limit price for when the order can execute. If you're buying and the stock price is below your limit price, then your order executes. If you're selling and the stock price is at or above the limit price, then your order executes. Now, what's the opposite of the limit order? A stop loss order. And that is designed to prevent losses. If you can only afford to lose, say, 4%, then you would take 4% of your initial investment and you would set your stop price to be that number. In most cases, if the stock's price falls to your stop price, then your order executes and you are limiting your losses. However, in the rare conditions that it falls enough so that it falls before it hits your stop loss price, then you have stop limit orders, which give the stock a range to trade in and in order for an order to execute. If you enjoyed that video, please like and subscribe to my YouTube channel. Also, make sure to check out my website, businessbasics.online. All the links are in the description. That's it. Thanks for watching.